I do not have to tell you that we are living through one of the most geopolitically unstable and policy uncertain and macro fragile environments of the last 15 years. And yet, market volatility remains eerily subdued. That contradiction is not benign. It's not comforting, right? It is absolutely not normal. This doesn't make any sense. What you're looking at right there is on this chart is a disconnect that defines modern markets for now. On the one hand, policy uncertainty is rising, driven by geopolitics, elections coming up, wars going on, fiscal stress always there, monetary regime shifts. We're going to get a new Fed chair and the court is already polluted, and structural inflation, meaning that we're not going to get down to 0% ever again. So on the other hand, the VIX, which the market calls the fear gauge, remains historically contained. That gap is a story, and that gap is the risk. Today, let's take a look at this chart and explain why markets priced for perfection tend to break violently, not gradually. And that is what we're looking for here, folks. This is what this channel is about. We're looking for black swan. We're looking for signs somewhere. So first of all, how to read this chart. So this chart plots two different indicators over time, starting around 2010 and extended to the present. The black line represents the U.S. Policy Uncertainty Index. The U.S. Policy Uncertainty Index. And the red line represents the VIX volatility. And basically the VIX is, not to get into the weeds here, but it uses options on the S&P to gauge what people are doing, what investors are doing. Are they bullish or are they bearish? They are measured on different axes, which is critical. The left-hand scale is the Policy Uncertainty Index, and the right scale is the VIX percentage. So these two series do not move one for one, and they are not supposed to. Historically, large spikes in policy uncertainty eventually force volatility higher. As you could see, during so basically what we're saying is that the policy uncertainty index, the left-hand scale, right, drives the spikes and eventually forces volatility higher. So first we have the fear, which is the black line, and then we have the volatility. Except that, as you could see, they're not matching anymore. And I guess the key is these two series do not move one for one, but historically, large spikes in policy uncertainty eventually forces the volatility higher. Basically, the black line drives the red line. But the key word is eventually, because markets can suppress volatility for long stretches until they can't. And then boom. That's what we're waiting. This is what we're waiting for. We're waiting for that spike. It's going to come. So what does this policy uncertainty index actually measure? Well, the US Policy Uncertainty Index is not a sentiment. It's not a vibe, right? It is a quantified measure built on economic policy-related news coverage, tax and spending uncertainty, regulatory ambiguity, and geopolitical spillover. When this index rises, it tells us something extremely specific. Decision makers cannot confidently price in the future. Corporations delay capex, households delay spending, and investors misprice risk. Uncertainty is the raw material of volatility, but it does not ignite immediately. So the historical stress point on this chart are essentially these: the euro crisis 2011-2012. You can see policy uncertainty spike as sovereign debt contagion spreads across Europe. The VIX react violently because the system was fragile. Right? You see euro crisis, you see the black line, and then the red line just shoots over the black line during the euro crisis. That was a Greek situation. You know, basically Greece couldn't make its payments, and they were going to go bankrupt, and they needed more money, and Europe basically said, no more money. You're all retired, 70 years old, and we're going to increase your taxes, and we're going to cut your benefits, and which is a good thing because now they're in pretty good shape. Well, then you have the U.S.-China trade war, as you call when Trump came in, start fighting with Chinese 2018 to 2019. Policy uncertainty rises sharply. Volatility spikes immediately, but remains capped due to central bank liquidity. And this is basically the one, the little spike, not as bad as the euro crisis, but there was a spike there. Okay. And then, of course, but it remained capped though. You know, due to central bank liquidity. So that's when the central banks got in and said, okay, you know what? Let's flood the market. Take it easy. This is the first warning sign of artificial volatility suppression. You flood the market with liquidity, then you're, with water. So you but it's not normal. It's not natural. Maybe sometime you need to let the pressure, and you didn't. Look at the COVID pandemic in 2020. This is the exception that's basically going to prove the rule. Uncertainty explodes, volatility explodes simultaneously. Why? Because policy shock, economic shutdown, liquidity crisis hit at the same time. They said, wow, we're in trouble. We're in big trouble. Look at that spike. But then section 4, we look at the current regime, the most dangerous one. Look at the right side of the chart. Policy uncertainty is elevated and rising again. But volatility is contained, muted, compressed. This is not because risk disappeared. It's because markets believe that the central bank will intervene, the governments will backstop, and liquidity will arrive on demand. This belief is the foundation of moral hazard. Remember 2008 and too big to fail? Hey, we were in banking. We thought, what's the worst thing that could happen? We're going to get bailed out anyway. Well, you don't want the banks to fail. And that's exactly what happened, right? So markets are not calm. They are anesthetized. They're sleeping artificially. So why price for perfection markets break hard? Well, when markets are priced for perfection, which we are now, every day you're going higher, you're more and more priced to perfection. 3 things are true. 1, valuations assume policy stability. 2, risk premia are compressed. 3, volatility selling dominates repositioning. Why do you think they're going after the Fed right now? They want to make sure. I mean, I know they're selling you this is a personal story. No, they want to make sure they got this thing completely under control. You've got to keep giving us liquidity. We cannot afford an iota of uncertainty here. So you got to keep the liquidity going even though it is not natural. So that creates a structural fragility. When the shock finally arrives, policy, geopolitical, fiscal, or monetary, there is no margin for error. Geopolitical. What do you think is going there? Do you understand? If you know what I know, and you're sitting on the other side, and you control everything, you want to make sure that, first of all, we've got the Fed under control. Then you want to make sure you get everybody else under control. Geopolitical. Do not start anything with me and with us, basically. So you want to assert control. Just in case someone decides to get a little out of hand, Russia, China, right? Iran, you're there. Because there's no margin for error. The volatility does not rise gradually, it reprices violently. This is how crashes happen in modern markets. Now, if you join my Patreon channel, I would explain to you what I do to prepare for it. Because the signs are there. The question posed on this chart is the correct one. Could a policy or geopolitical shock finally upset the apple cart? Yes, always, eventually. Not because shocks are unpredictable, but because markets refuse to price them until they are forced to. So, in closing, low volatility is a high uncertainty world is not stability. It's a warning light. When policy risk rises and volatility stays compressed, the eventual move is larger, faster, and more disorderly. The chart is not telling you to panic. It is telling you to stop being complacent. That's the reason why you need to watch out. Is Bitcoin season coming? Well, I mean, it's approaching 100,000, so. But Bitcoin, basically, what's going on with Bitcoin is that it is becoming a normal asset, right? It's not this thing that would go double and triple anymore. You know, they have shown the 5 stages. Those are gone. So now everything is going to simmer down. Most investors do not understand what regime they are in. They think that they're investing in stocks. In reality, they are making a relative bet between financial assets and real assets, whether they realize it or not. And think about it. What you do in your right hand, you can't do in your left hand. And basically, you got to pick what you want to do. And whenever you do something, even if you don't do anything, you're doing something. You're missing an opportunity. And the chart on your screen right now is one of the cleanest, longest duration ways to see that battle play out across history. So this chart is not about a headline. It's about where capital is flowing over decades. And right now, it is flashing a warning that a few are prepared for. So let's throw this down and explain exactly what this chart shows. The top panel displays 2 lines over multiple decades. The Bloomberg Commodity Spot Index, commodities, in red, and the S&P in blue. Both are plotted over a long-term horizon, smooth with moving averages so we can observe secular trends rather than short-term noise, okay? This is crucial because markets move in cycles, but capital rotates in regimes. The bottom panel is where the real signal lives. This is a ratio of commodities to equities. You may not see it, right? You're seeing everything going up, kind of. The ratio tells you whether real assets are outperforming financial assets or vice versa. So when the ratio is rising, as you've seen on the left of the chart, commodities are outperforming stocks. And inflation pressure is rising. Scarcity matters more than growth narratives. When the ratio is falling, stocks outperform commodities. Financial leverage works. Disinflation dominates. Liquidity wins. This is arithmetic, right? This is not an opinion. So how do you read this ratio? Now, here's the most important thing to understand. The ratio does not move randomly. It moves in long, grinding waves, 10, 20, sometimes 30 years. Look at the historical panel. Look at the 70s and look at the early 2000s. Take a look at it. Right? Do you see it? Look what it's doing. And from the 70s to 2000, energy mattered. Raw materials mattered. Supply chain mattered. Monetary credibility was questioned. And during those periods, even when stock went up nominally, they underperformed real assets. The distinction destroys portfolio if you ignore it. Look at the 1980 to 2000. The long collapse of the ratio from the early 80s to the late 90s. This was the era of the Volcker credibility, falling inflation. I don't have to remind you, Volcker basically came in and said interest rate 20%. I mean, not 20%, but close. Falling inflation, because we had to bite inflation. We were in a recession because of what happened with Arthur Burns and Nixon. Globalization, offshoring, and financial engineering. This is when equities absolutely dominated commodities. That worked. Valuation expanded. Growth narrative thrives. This period trained multiple generations of investors to believe stocks always win, right? Stock can't go down. That belief is the most dangerous inheritance in modern markets. Now take a look at 2000, 2011, the commodity resurgence. Something changed. The ratio surged again in the 2000. Why? Because China industrialized, energy demand exploded, supply chains tightened, and monetary expansion accelerated. So this is the last true commodity-led cycle. And notice something critical. Stocks still rose, but commodity rose even more, as you could see. Relative underperformance matters more than absolute returns. This is when portfolios silently break. Now, the post-2011 suppression. After 2011, take a look at it. The ratio collapsed again. Why? Central banks suppressed volatility because they just kept flooding the market. Yield curves flattened. Capital flooded financial markets and financial assets, and real assets were starved of investments. This created the illusion of abundance, but it was a monetary illusion, not a physical one. Underinvestment does not disappear, it accumulates. You are here. You see that on the right? The arrow, the ratio is sitting near multiple decades lows. This is not normal. This is extreme. It tells you the following. Commodities are historically cheap relative to equities. Historically, we're talking about, right? I'm not saying gold is cheap. We're doing a ratio here. We're not doing how expensive it is. Financial assets dominates portfolios. Duration risk is massive. Supply risk is ignored. This is exactly how regime shifts begin, not with a panic, but with complacency. Look at the sign. So what does this mean for your portfolio? Well, it doesn't mean sell all your stocks tomorrow. What it means is expect relative shifts, not crashes. Expect volatility to rise. Expect real assets to regain pricing power. And expect, which it's happening, equity multiples to compress, not explode. The biggest risk is not being wrong. The biggest risk is being positioned for what used to happen. So in closing, let me say this. This chart does not predict next week. It defines the battlefield for the next decade. This is what this channel is about. I want you to join my Patreon channel because there I take all that information that I've gathered and make decision for my portfolio. I say, come over and look at it. This is what I'm thinking about in real, because you got to do something. If you ignore it, you will spend years asking, why didn't my portfolio perform the way I expected? If you respect it, You adjust early, quietly, rationally. Now, not when the market is collapsing, now you're selling. Markets punish arrogance, they reward preparation, and the chart is preparation. Someone asked me today, hey, what's your view? What do you do with your money? I said something very interesting. It came to me just like that, and I want to share it with you. What I said, and I'm going to have to save it somewhere because I just sometimes you say things and it makes total sense, but sometimes you have to say it in. There is no secret to making money in the stock market because everybody wants to know, well, what are you buying? I want tell me what to do so I could make money. There is no secret. You need to be first. That's how you make money. You have to be first. First to sell, first to buy. And to be first, listen to me, to be first, you need to know and take measured risk. You need, and for that, obviously, you need to understand risk. Second, everyone is selling, you want to be the one buying. And when everybody's selling, you want to be the one buying. And the one selling, you want to sell when everybody else is buying. And you want to start looking for fat tails. That's what we're doing here. This is the idea of the black swan. We're looking for flat tails. And therefore, what should I be doing with my money? Well, it depends your situation, right? So you have to figure it out on your own. But I think the most important thing what this channel does is it educates you, because things are going to happen. And once they happen, it's too late. You need to be first. Take a look at this one now. This one. Complicated. But that's okay. That's what we're here for. It was easier, but you'll be doing it. Unfortunately. I mean, that's how it is, folks. If it's easy, everyone will do it. So let me take you through this one because that one I think is a doozy. So we're looking at this chart. And I talk to my Patreon channel members every morning, 8 o'clock. Give him some views. Okay. So what is this doing? Let's start with a simple but dangerous illusion. Markets feel calm. Volatility feels contained. Risk appears priced, managed, and under control. And yet, geopolitical uncertainty is exploding. To tell you what's going on. That contradiction is exactly what this chart exposes. So I'm going to walk through with it so you could take a look at it and see the implication. It shows complacency at the edge of rising political fracture. And historically, that is when markets break. What are you looking at? This chart compares 4 distinct forms of uncertainty plotted over time. 1, equity market volatility. 2, bond market volatility. 3, trade policy uncertainty. And 4, geopolitical uncertainty. Each line represents a different risk regime, and each axis tells a different story. Okay, so we're looking at basically those lines. Geopolitical uncertainty is the red line, and then you've got the bond uncertainty, which is a purple one, and you've got the green one, which is the equity, and then you've got the blue one, but frankly, it is gone the global policy uncertainty. The horizontal axis runs from late November through early January. This is critical. This is not a multi-year academic comparison. This is real-time, short-cycle risk behavior. These are the windows when volatility normally rises, not falls. On the left axis, what do we have? you are seeing equity volatility, commonly referred as VIX, bond volatility, rates and duration, and these lines represent market implied risk, meaning that is what traders are actively paying for protection against. So what do you notice? They are falling. The equity volatility and the bond volatility, look at the circle, right? The two circles, the bond, and they're falling. It's where on the right, as of January. Why? So on the right axis, you see geopolitical uncertainty and trade policy uncertainty. Now, this is on the right. And what's going on with that? The red line is measured with the right, the other guys are measured to the left. Right? So we're clear. So on the right axis, you see, and they are not market prices. They are the macro risk indices derived from news frequency, policy references, conflict mention, trade and tariff language. So geopolitical stuff. In other words, this is a real world risk backdrop. And it's rising sharply. So what is a core contradiction? Well, as geopolitical risks surge, market volatilities collapse. This is not normal. This is not neutral. This is unstable and unsustainable. So what is the problem? Well, market exists to price uncertainty, right? It's price discovery every day. How much is Tesla worth? P of 100, P 150, and all these hundreds and thousands of people doing trading, they kind of trying to come up with a price. So when uncertainty rises, volatility should rise with it. But here the opposite happened. This means one of two things. Markets are correctly forecasting that geopolitical risk will basically not spill into financial markets. And two, markets are dangerously mispricing tail risk. Now, obviously, I'm not the only one seeing that. Well, they're also seeing it, the one making the decision. So when they're saying that markets are correctly forecasting that geopolitical risk will not spill into financial markets, they're saying, you know what? We're going to get away with this. Let's take over this. Let's do this. Let's take over that. Let's go here. Let's take this guy here. Let's bring him over here. Who's going to do anything? Or markets are dangerously mispricing the tail risk. The tail risk, the black swan risk. That's what I tell my Patreon channel members all the time. Watch for this risk. Prepare for it. Not when it happens. Too late. You need to do it before. You need to do like Michael Burry did. Hedge the entire financial system. And it worked. So if markets are mispricing, history usually overwhelmingly favors the second explanation, which means markets are dangerously mispricing tail risk. So let's walk through the chart visually and sequentially. On the left side of the chart, equity volatility is elevated but falling. Bond volatility is declining. Geopolitical uncertainty is already high. This is a risk normalization narrative. Yes, there are headlines, but nothing systemic. Okay, the assumption is a bit fragile. Early December, notice what happens next. Geopolitical uncertainty jumps sharply upward, but equity volatility does not respond. Bond volatility does not respond. This is the first divergence. This is where risk disconnect begins. Why? Now, the divergence widens, geopolitical risk spikes again, equity volatility makes lower lows, bond volatility compresses further. This is not hedging behavior. This is volatility selling. This is structured products, carry trades, and leaning in. So in late December, this is the most dangerous part of the chart. Geopolitical uncertainty is rising into year end. This is when liquidity is the lowest. This is when positioning is most rigid. This is when stocks propagate faster, and yet volatility is collapsing. This tells you something critical. Markets are not prepared for disruption. They must know something we don't. Finally, look at the far right side of the chart. The geopolitical uncertainty line is accelerating upward. This is even a dash projection suggesting continuation. Meanwhile, equity and bond volatility remain suppressed. This is a setup. So why markets keep making this mistake? This is not new. Markets repeatedly underestimate geopolitical risk because, one, geopolitical events arrive non-linearly. Yeah, we got up one morning and we took the guy out of Venezuela. And then we said, you know what? Now we want to buy Greenland. They do not fit standard valuation models. They invalidate correlations suddenly. They strike when liquidity is thin. So markets price what they can model. I don't know what's going to happen next. Geopolitics cannot be modeled, only ignored until it can't be. Are there historical parallels? Well, this pattern happened before major conflict escalations, before trade war announcements, before sanction regimes, before sudden policy reversal. And each time volatility stayed low until it exploded. So what does this mean for different asset class? Let's talk implication. For equities, low volatility encourages leverage. Leverage amplifies shocks. When volatility finally reprices, equity gap, not drift. Huge collapse. Bonds. Compressed bonds volatility assumes policy continuity, predictable inflation path, stable insurance dynamics. Geopolitical shocks destroy those assumptions. What about commodities? Well, these markets move first. Energy, metal, shipping routes, credit risk premium, currency risk premiums, they are the transmission mechanism. So how to read this chart going forward? This chart is not telling you what will happen. It's telling you what is mispriced. When geopolitical risk rises and volatility falls, markets are borrowing stability from the future. And borrowed stability always has to be repaid with interest. Watch this divergence. When it closes, it will not be gentle. This chart is not about fear, it's about discipline. Understanding risk, which is what we're here for, means recognizing when markets are calm for the wrong reasons. And right now, calm is not confirmation, it is a warning.